Hello and welcome to a special webinar from Fat Profits. I'm Roger Malik, the Head of Client Services in our Sydney head office. Thanks for your company today. There's a lot happening in the market, of course, so the conversations around the dinner tables is, are we headed for a recession or is this just a correction? So we'll be sharing our insights from Fat Profits on where we see the markets. We'll also be providing plenty of ideas on what you can do with your portfolio. And there are a number of buy, sell, and avoid recommendations. And we also have a hidden gem, which is an absolute brilliant opportunity if you've got a bit of cash that we'll be presenting to you towards the end of the webinar. So stay tuned. Hopefully you've got some pens and papers handy. We will be providing some ideas for you to make a note of. Joining us in today's webinar is our Senior Account Manager, Edward Allen. Edward, welcome to the webinar. How are you going?
G'day, Roger. Always a pleasure to be here. Interesting times in the markets, so we're happy to share those thoughts and ideas with prospective investors today.
Absolutely. Thank you for your company, Edward. Let's get into it. But before we get into our presentation, all our webinars from Fat Profits are general information only. We don't provide you personal advice. If you're looking for that, please see your financial planner or advisor. And also past performance is no indicator of future performance. Now, we've got a Q&A session at the end of the webinar, and you can type in your question at the end of the webinar. But if you do have a burning question while we're talking about a topic, we encourage you to ask that, and you just type in on your screen and we will be able to help you with that. So hopefully we don't have 500 questions, because that'll be a bit too much, because we do have 500 seat capacity and we've got about 400 odd at the moment, and we may get a few more in the next few minutes. So please feel free to ask a question when you feel the need to do so. Now let's get into the market discussions. Firstly, we'll discuss about the markets first. Do the macro snapshot on where the markets are at, what's causing it, and how we can navigate through these absolute downturns that we're seeing in our portfolios, let's face it. Then we'll get into the discussion on topics, on stocks a bit later. So first up, let's see the health of global markets. The best performing index at the moment, year to date, is FTSE, which is the London Stock Exchange, only down 5%. And you put that in context, ASX is down 13% so far, but the big heavy falls are certainly felt in the US markets, none more than NASDAQ, which is a tech heavy index and full of high growth stocks, so 31% down. Now, just to provide you some definitions, when a stock market drops more than 10%, it's called a correction. When it drops more than 20%, it's called a bear market. So at the moment, ASX is still in correction mode, while the US markets have gone into a bear market. Now, does that mean doom and gloom and everything should be just going down for the next few months? Not necessarily, and we'll explain that in a moment, but just park that for a second. Let's look at the reasons for the big drop this year. The obvious reason, firstly, is high inflation, not just in the US, but pretty much in most economies around the world. We're also seeing rising interest rates by central banks around the world to stop the inflation. We've also seen lockdowns in China, rising COVID cases, which hasn't helped certain commodities. And of course, we're seeing a self-induced slowdown in the US economy to curb the inflation. These are the main factors, amongst, of course, the war in Ukraine. Now, as the old saying goes, if the genie's out of the bottle, it's very, very hard to put it back in. And that's what we're seeing with inflation at the moment. The inflation genie has essentially been let out of the bottle by the central banks, and they've been very slow in reacting to the early calls of inflation rising last year in 2021, and that's causing some issues now. If you look at the US market, you see the inflation from last year to this year, and you're seeing where the biggest changes are. Certainly gas prices transportation, household energy, food, housing, rent. These are some, to name a few, and that's causing headaches for the consumer at the moment. So Ed, let's have a look at the US inflation. I'd like to hear your thoughts on US inflation, which is now at an all-time, well, I wouldn't say an all-time high, but a 40-year high, 8.6%. Just a month before, we started to see a bit of a drop from 8.5 to 8.3. The markets were sensing maybe we've seen the peak, but now we've seen it's going back up to higher levels. What are your thoughts on the inflation at the moment, and how can we get this under control?
Look, consumer spending habits to start with doesn't change straight away, so it's going to take time. I was out in the shops on the weekend, people spending as usual, but once they start getting the electricity bills and start filling up at the Bowser, things will start to change. The mortgage repayments, for instance. So these interest rate hikes will eventually bring inflation figures down. And once you start seeing those figures fall, as an investor, you've got to ask yourself a question. I mean, what do you think is going to happen? We've been doing this, Fat Profits for 22 years. We've seen this, not the same dynamic, but similar dynamics before, where it's all fear and doom and gloom, and everyone starts emotionally selling off their portfolios, thinking it's the end of the world. And then all of a sudden, the metrics change. And that's a period that we're going to head into over the next couple of months. So I believe the inflation numbers will start to fall, and then the savvy investors are actually topping up and accumulating stocks right now.
Absolutely, that's a very good point, Ed, because this chart here in front of us shows us the consumer price inflation over the longest period that we can go back from 1910. World War First, obviously we saw huge inflation, but we can see then it went to deflation, went below the line. World War II, of course, we see always inflation in these, and then of course 70s. For some investors watching this webinar would probably live through the 70s and would remember high inflation as well. And now we're seeing another spike, not to the same levels, but you can see on the extreme right-hand side, certainly getting to that, closer to that 10% mark. Now, as it goes up, nothing goes up in a straight line. We expect that to drop at some point in time over the coming months. And as you said, when that does drop, what's going to happen to the markets? Well, we will see a reversal in share prices. This is a chart of the S&P 500, the US top 500 companies, price to earnings ratio, PE ratio as its short form. And you can see this, it goes back from 1988 up until this year. And we've seen periods where the price has gone far beyond the normal average, gone up to 29, 26, 21. And recently it also hit 30, which is all-time high. That means everything was more expensive in the US corporate sector. But now, because we've seen a huge drop of 20 to 30% in the stock markets, it's actually come down to 17.8%, which is just below the all-time average of 18. That's another reason not to panic and maintain your positions if you haven't done so already. But looking at the charts as well, Ed, if you look at the S&P 500, absolutely it's down about 20%, 22% from its recent highs. But as you said, if we start to see a reversal of inflation, or at the very least, a consolidation of inflation, and no more further rises over the coming weeks and months, we do expect some buying, because there's a lot of cash sitting on the sidelines now, isn't it?
Yeah, there's just way too much liquidity in the system. We know about all the stimulus over the last 2 years, but a lot of people, in particular in the US, have made a lot of money in the markets over the last couple of years. Now, some of that money will be sitting on the sidelines at the moment, a big chunk of it, and that money will come back in and it will push markets back up. But it won't be the same stocks that went up last time. It'll be value stocks. It won't be as much speculative growth stocks. There will be a couple that will be manipulated and pushed into algorithm programs and so forth, as we've seen in the past. But value stocks are the ones that where the smart money is going to go, and that's what we've been already starting to show our members where they should be focusing their investments.
Absolutely, that's a great point. If you look at how the certain asset classes have performed over the last year versus this year, this chart will show you, well, firstly, you can see on the top left, you can see the S&P 500 Dow Jones year to date, obviously down versus last year. But you also see the absolute red color here, which is the Bitcoins and the Ethereums, the cryptocurrencies. Really, the sky is has fallen for them, unfortunately. I mean, if anyone's holding them, you're probably feeling the pinch, but last 2 years haven't been kind for speculative end of the market. But you also note here on the right-hand side, where you see agricultural commodities, oil, energy, natural gas, and commodities, they've been green for 2 years in a row, and that's where a lot of money is moving to. So this, as Edward said earlier, the speculative money is coming out of the market and moving into value, moving into where the growth is, and that's certainly in commodities and so on. Ed, let's have a look at Australia now. Australian inflation is still at a reasonable number, 5.1% compared to the rest of advanced economies. And our GDP annual growth rate is pretty respectable compared to our long-term average. What are your thoughts on Australia? Are we bullish on Australia versus the rest of the world?
But we're in a far more superior position, especially in the investment world that we're in. You know, we have superannuation. You know, funds are going to continue to come in because obviously we've got record low unemployment. And even if unemployment went up 1% from here, we have a buffer that the rest of the world simply does not have. Also, in saying that, you know, there's a lot of liquidity in the Australian market. I've had members that I've been speaking to that have sold out of investment properties for all types of reasons, and they need to put it somewhere, and they're going to take advantage of this market. Same as what happened 2 years ago, you know, around the middle of 2020. You know, a lot of money came in off the sidelines out of term deposits, which were earning nothing, and you know, the risk was taken, and it pushed certain stocks up, especially high quality dividend paying companies, and also the ones that are paying good franking credits as well. So we're in a very good position.
Yeah, absolutely. Look, another reason we're bullish on the Australian market is, you know, our dynamics are very different compared to the US and other markets. So you can see here, financials and materials make a big chunk of our market, and healthcare as well. Materials, we're quite bullish on. Financials, look, they've taken a bit of a hit in the last month, but generally speaking, they've well cashed up. But of course, you've got to be selective. We'll talk more about it later. But looking at the ASX 200 now, Ed, we're sitting on a bit of support level at the moment. We see the orange line. We expect that to hold up because we've seen a rather large drop, even though our economy is in better shape than the rest of the world. What are your thoughts on the ASX 200 for the second half of this year? Are we expecting a better response and climb back past that 7,000 points?
We will. Once these inflation numbers are under control, pretty much it'll be the old saying, all the bad news is out of the bottle. So I'm not saying we're going to have good news going forward, but yeah, there's a lot of liquidity on the sidelines. You know, people we're speaking to, Roger, every day, just waiting to get that money off the sidelines and into the markets, and the yield that's on offer on high quality stocks is the reason to be in the markets. But we expect to turn around in the second half of the year, and these things happen quickly these days. You saw what happened 2 years ago. You look in the rearview mirror and it's, oh, gee, I should have done this and I should have bought that. Why didn't I do this? The reason is because you're sitting in an emotional state of mind. As an investor, especially if you take the responsibility of managing your own portfolio, you need to make decisions. You need to make informed decisions. Our decisions here at Fat Profits are backed by research. It's as simple as that.
Very good point. All right, let's have a look at what's happening at the moment. The BHP strategy is taking hold of many investors, as Edward, you just mentioned, the emotional state. And that BHP strategy, if you are not aware, is just like this guy standing there praying to God. I think a lot of investors at the moment, they bought stocks, they're holding them now, and they're praying that they'll come back up. Well, look, to one extent, I think everyone does that at some point in time, but if you've done your research and you're not emotional about those decisions you made, backed up by solid research, and you have conviction in your purchases, you should not be worried and you should not panic sell. That's what we're telling our investors, is the stocks that we have researched should hold. The other thing is dollar cost averaging. That's another strategy we're suggesting to investors right now, is don't buy anything in one hit. Buy them in lots of different stages. So it gives you a chance to capture the same stock at different time frames to allow you, because nobody's going to pick the absolute bottom out of a stock. And if you have, well, good for you, but chances are very, very few will. So why give yourself a headache trying to pick the absolute bottom out of the market? But instead, give yourself a chance, buy in different stages, and that brings your average down. You have skin in the game, and when the markets turn, well, you're not sitting there left out waiting for the absolute best opportunity. Now, for that, we actually have a income portfolio which is dedicated for self-funded retirees or self-managed investors who want the best dividends in the market from top 200 stocks, and they also want to protect the capital in these turbulent times, as well as get some level of growth. Now, Ed, this portfolio has been going for 10, 11 years now, and it's got 22 stocks, and it's averaging 17.1%. It's dropped 1% in the last quarter. It was 18.1% previous quarter, but it's dropped 1% in a quarter, which is pretty respectable given the markets are down 13%, but currently sitting at 17.1% as a combination of dividends and growth. So what are your thoughts there, Ed? I mean, who do you think is ideally suited for this type of portfolio in this market today?
Look, it's more for conservative investors, investors that rely on income, dividends, not so much growth, but we've delivered growth over that 10-year period, Roger. And we've selectively added and removed stocks over time. Now it gets updated quarterly, 4 times a year, and we'll make those adjustments at each quarter. But it's consistently delivered results for 10 years. So we expect that to continue because markets, go through growth periods, they go through bearish periods, which we're in at the moment. Now's a good time to be accumulating some of these stocks and locking away some of those dividends. And I know members call me quite regularly on this particular portfolio, especially the ones that have money to put into the market, well, especially right now.
We've just got a question coming from Margaret. She's saying, is this a portfolio that you guys manage for us? Does that mean we part the money and you manage it for us? So Margaret, to answer your question, thank you for that firstly. No, this is not us managing your money. This is a research portfolio which is for you as a member. So if you're a member with Fat Profits, you will have a password to log into the website, and you'll be able to see all the stocks in this portfolio, which we are hiding at the moment, obviously to protect the IP for the members who are paying for the service. But these 22 stocks, you'll be able to see all the names, you'll be able to see all the research next to each stock, and you can either match this portfolio and reflect that in your own, or you can cherry pick out of these 22 stocks. You can cherry pick maybe 4, 5, 10 stocks that you like. The idea behind this is to give you, as an investor, the power to manage your own money, but give you the research to back up your decisions as to what type of stocks you want to hold. Now, to give you further examples on this, if you look at this breakdown, now we're showing 1 or 2 stocks here on the left, but this same portfolio is showing you a breakdown of how many dividends you can expect to earn per stock. And you can see, for example, if you look at the financials at the top, you can see the net yield financial year 22, financial year 23 per stock, and then gross yield, which is obviously including the franking credits. And you can see which ones are fully franked 100%, which ones are 0 or otherwise. Now, the key for you as an investor, Margaret, or for the others, is to look at the portfolio average right at the bottom. The net yield financial year 23 is 5.4% from the whole portfolio, and the gross yield, including franking credits, is 6.6%. And I'm sure you'll agree that if you can generate 6.5% of consistent dividends, and look, some of these stocks are 10%, 12%, some are 7.5%, some are 9%. So you can cherry pick those ones. But would you agree that if you can get 6.6% gross yield across a basket of stocks in the top 200, that'll be pretty healthy outcome given where we are in the market. So Ed, happy to take any final points from you if I missed out on anything.
No, that's pretty much it. This has been running for 10 years. A lot of members follow this religiously. I mean, if you've got a very large portfolio, you could afford probably to buy the entire portfolio in your super fund, for instance, and just follow it religiously. So I know a number of members that I've been looking after for, almost 10 years at Fat Profits have followed this religiously. And I was a big, I pushed this portfolio. I remember back in 2012. It's what members were asking for, something that they can stick in their super fund, manage themselves, manage effectively, and it's worked out really well. So happy for those members and any future members that decide to follow this strategy.
Well, I think one final point I will make is, look, there's 400 odd people. In fact, I can see here on my screen now about 480 people now watching this. So out of all of you who are watching this right now, ask yourself the question, what are my returns? Am I getting 5-6% dividends from my total portfolio? Is it returning 17.1% a year for 10 years consistently? If the answer is no, well, look, if you park your money with a fund manager and you give them, let's say, $1 million to manage it for you, well, firstly, the chances are for them to get 17% returns, which is, I'll go back to my previous screen, and you can see on the bottom right, that's 17.1% return. Chances are the fund manager is not going to get that for you. Number two, they'll charge you 1.5 to 2% a year in fees. And on $1 million, you're looking at $10,000 to $15,000 in fees for a fund manager to do that for you, and most likely they'll follow the market. If the market is 7 to 10%, that's what they're going to get for you. And this portfolio has been generating 17% returns per year for 10 years. So I suppose the question is, if you can do that yourself, well, why not? And if our fees are way less than $10,000 a year, well, then why not? So this should be the biggest reason for you to join our service, and certainly look at this in today's market. Moving on to the final thing on the macro side, before we look at a few stocks today, financial sector. Now, Ed, this sector is very important for investors because nearly all investors have some money in a financial stock, whether it's a bank, insurance company, or a financial planner or a platform. It has been rising pretty well since COVID lows, but lately the sector's dropped about 15%, give or take. There's been a few reasons, but what are your thoughts overall on the financial sector? Are we still happy to hold some stocks in this space?
Yeah, very, very strong sector. We don't cover all stocks in this space, but we have selected stocks. But the stocks that we cover, yes, absolutely. We've seen pressure on the likes of CBA, for instance, which is one of the largest cap in this sector, and Macquarie as well. So we haven't been exposed to those two in our preferred portfolio, but they've dropped the biggest margin in the current correction. But look, there is a buffer there. The banks have a buffer. There's a buffer in the mortgage market. Most people have had a rise in their property over the last 2 years, so there is a buffer there. So it will be a soft landing in our opinion. Nothing too much to be concerned about, but all banks' fixed costs have gone up, but their margins have increased as well with the interest rate rises. So it's about which business is able to manage that balance effectively, and that's what we're focusing on at the moment. So we still have a number of opportunities that have just become genuine buying opportunities at the moment with the recent correction.
Absolutely, a lot of them look undervalued at the moment, so you have to be selective. Moving on to having a look at Fat Profits, who we are, what we do. So here's a picture of Angus Geddes, our CEO. Some of you may have seen him on lots of interviews on AusBiz or CNBC, Bloomberg channels. He's very popular. He's also a fund manager. So he opened Fat Profits in 2000. We've got a Sydney head office, that's where Angus is based, and we all are. We also have an office in London where we went into 2003. We have a wealth management division where Angus and his team manages up to $1 billion. And we have an office in Auckland as well. So we're a global company. We do stock market research, and we provide that research to our paying members. And we have about 25,000 members globally, and they follow Fat Profits' views. and follow our recommendations. Now, what markets do we provide that research in? Of course, Australia being one, but we also cover Asia, US, UK, Europe, and emerging markets. So certainly a lot of coverage, and we're not stockbrokers. Just to be clear, we don't manage your money and trade for you or buy and sell for you. No, you manage it yourself through your own platform. We provide you the support and the advice and the research. So that's what our company does. Ed, we've been blessed to have some excellent analysts. Of course, Angus leads the team, but we've got David Lennox as well, and he's been with us for over 10 years.
That's right. And just on Angus's report, he's the fund manager. So we're the only service, as far as I know, if anyone can correct me, in Australia, we actually receive, as a member, a report from a fund manager every day. And it's actually our long-term members tell us that is the most valuable report. No, not so much for stock picking on a weekly basis, which is not Angus's picks. Angus is wealth management. So as a premium member, you'll get Angus's report complimentary as part of the service. And the weekly reports are from the analysts. So that's their picks, their predictions, not Angus's predictions. But you get two views. But yeah, to get a report from a fund manager as a self-guided investor is gold, and that's why our members stay with us. Now, David Lennox is an expert in mining. He's an ex-geologist. He's also worked at Colonial Mutual Life and Norwick Union Life, and you can see there on the slide. But he's well trusted, very respectable. He's picked many 10 baggers over the years, or 20 baggers, some even more than that. So it's his value investing approach. He does tend to stick to the same list of miners because he knows the clear fundamentals of those businesses, and those businesses continue to rise over time. So a lot of those have come back a little bit enough in the short term to become buys again. So we do have a number of buys in our mining report at the moment.
Absolutely. Thanks, Ed. And finally, we also have a wealth management division where, as we mentioned earlier, Angus manages lots of different portfolios, some global, some Australian, some focus on dividends. And this is an example of the Australian portfolio that Angus manages. The orange line is, of course, our Fat Profits is concentrated Australian portfolio, and that's returned 338% since inception in 2007 versus the ASX 200, which has produced 122% return at the same time. So it's pretty clear this is real money, hard-earned money of our members who've trusted Angus to put that in the market for them, and we've nearly tripled the market return. So this is not a joke. This is serious money, and a lot of retirees and semi-retired people trust Angus, trust our company to manage up to $1 billion of their money. So we are doing a good job, as you can clearly see, and all this is on our website. Now, looking at our research, let's look at a few stocks today, and we're going to give you a few stocks now. So stay tuned, and there's a hidden gem coming up towards the end of the webinar, which is an absolute rocket of a stock. But first thing first, looking back at the rearview mirror, last year, we produced 3 out of the top 5 stocks on the ASX 200 that we researched and recommended to our members. The first one was Chalice Mining, which was absolutely the biggest stock on the market, CHN, and we'll talk about that in a moment, up 5,800%. Number 3 was Hub24, and number 5 was Orocobre, which is a lithium producer, but they've changed the name recently. So we picked 3 out of the top 5 in the market last year. So pretty proud of that. It's not easy to achieve even 1 out of the top 10, let alone 3 out of the top 5. So we must say, look, pat on the back for the research team. But having a look at Chalice Mining first, CHN, this is a company who've got portfolios across Australia from WA down to Victoria. They have nickel, copper, palladium, cobalt, even gold they had in the past. So they've got portfolios. They've had one of the biggest discoveries in Australian mining history as well. Ed, this stock has produced some unbelievable returns, including Grant, who's one of our young 33-year-old members, who's made an absolute killing out of this stock. And you've spoken to quite a few of these members.
Yeah, absolutely. Like we've had a number of these. This is obviously the biggest one. We've had another one that's pretty close to this one as well. Yeah, just new investors that come in off these webinars, for instance, who buy a mystery stock or a hidden gem that we're going to show you today, and make some money initially. So get off on the right foot. So yeah, you make your own luck in the market. You've got to have the research, you've got to have the information, and you've got to have the confidence to invest. You know, it's not a one-way street. All the stars need to align. So the people that have the confidence that they can get these type of returns over a very long period of time. So you only need one. You're not going to get all of them, let's face it. But if you get one, and especially for a new investor, there's a number of these that have bought some of our smaller mining stocks that have just blown out to be extraordinary performers in our portfolio. So we're in a period at the moment where anyone that has confidence to invest in some of the stocks that have pulled back, like this one. So this was a hold for a long time, Roger.
Yeah.
It's just come back as a new buy. It's dipped below $4 even around below $5, sorry, recently. So it hasn't been at this level for a very long time. And it's become a new buy in our portfolio. So it's, again, they've got plenty of air under the ground, multi-deposits. They spun off one of their gold assets to Falcon Minerals, which is a new company. So their focus now is really on, precious and battery metals. Yeah.
Yeah, absolutely. So just to finalize the points here, we bought this at 12.5 cents a couple of years ago in 2019. We held it all the way up close to the top, but along the way, we also took some profits. So we also tell you not when to buy. We sold this a couple of times along the way. We locked in some big profits here, and then we kept it on hold for many, many months until recently, when it's now dropped to around $4 to $5, and now we've changed that rating to a buy. So this is our first buy recommendation for our viewers today. So you can check this out. We do see some value at these levels. So this is what you're going to get as a member. We tell you when to buy, when to sell, and when to hold as well. So this is currently a buy recommendation. Next up, having a look at the soft commodities. Now, certainly, as we talked about earlier, soft commodities, agricultural commodities, they've seen a lot of growth in the last 12 months or so, but more so in the last 6 months. And you can see that on your charts. Food, there is absolute inflation on food. We all know that when you go grocery shopping. I know I've been feeling that Ed lately. And that's
lettuce,
partly things.
$10
Lettuce,
lettuce. Yeah.
well, talking about lettuce, to look at the timing. This was a joke on social media. Someone saying this girl proposed to, or asked her boyfriend to say, "Take me somewhere expensive in Australia." He said, "Not a problem." Took her to a lettuce farm, and they're having a dinner date. But it's the most expensive place in Australia. $10 per lettuce. Who would have thought?
That'll be my backyard in about 3 months.
I wouldn't doubt that, Ed. So, but look, on a serious note, one stock we can give you today as a buy recommendation is one of the most trusted Australian agricultural companies called Elders. Most people know this company, but if you don't, well, we'll tell you a little bit about them today. Ed, this company have got a huge performance over the last, well, years and years, but more so in the last 1 to 2 years, and it's clearly evident in the charts. You can see the first half of this year, 22, pretty tall red building versus the last 3 or 4 years. The financial numbers, sales revenue, everything is going up. The dividends have gone up, but also looking at their peers, the red line here shows Elders' performance versus its competitors, which includes, Costa Group, Grain Corp, and the others, which are nowhere near close to Elders. So this has been an absolute standout.
Yeah, absolutely. They've got technology as well for the agricultural sector, which they haven't really, their earnings, they haven't really shown on the balance sheets at the moment. So look, if they can keep their costs under control, I mean, obviously the sales will cover their costs. You saw that on the charts. So this is a stock that's performing quite well at the moment, and it's going to do very well in this current market. Will it boom? Probably not, but it should consistently grow. So this is one stock in our portfolio that's gone against the grain, where you know 2/5, I think, of the ASX 200 has gone down. This is one that's gone the other way. So that's why we're putting a buy on this stock
Well,
for our members, and also sharing
absolutely.
the buy with you today.
Great. Well, this is a second buy recommendation for you, so hopefully you can check it out. But another stock which is, you know, if you do your research properly, you hold them long enough, and that's another key. Don't buy and sell. Hold them long enough, you will get some profits. Now, we've given you 2 stocks today so far. We've got a few more coming up in a moment. Let's also look at what stocks we can avoid in this market. Now, it's important to know that, because sometimes people get emotional and look at the charts and go, well, this looks cheap, let me buy. So let's have a look at the first one, Wesfarmers. Of course, they own, you know, Bunnings and Kmart and Target and plenty of retail chains. But looking at this chart by itself, Ed, they've had their peak around $67 earlier this year or late last year. We think at Fat Profits that this stock has seen its best days, and they're facing some challenges over the coming months ahead. So we're avoiding this stock.
Yeah, beneficiary of stimulus. You can see in that chart over a 2-year period, it boomed. People were out there spending. But look, now it's all back to fundamentals. You know, their fixed costs have just gone up. You know, the minimum wage has been raised, which is a big bulk of their business. Bricks and mortar costs are rising as well, and you know, diminishing sales from the online space, the e-commerce space. But yeah, look, the only reason most people who still hold this stock are holding it for the dividends. But look, unless you bought it very cheap, it's eating away capital at the moment. This whole space is going to struggle. You know, mortgage repayments are going up, which means people are going to have less to spend on discretionary products.
Yep.
Including this particular business. Obviously owns Target and Kmart and the likes, and Bunnings.
Yep.
So the numbers are going to fall. They're going to have to aggressively price reduce products to get the volumes up, which, you know, will not necessarily get the return that investors have had in the past.
Sure. And look, we said that about 3 months ago as well in these free webinars, when it was trading around $52, that this is an avoid, and we're still avoiding it at the moment. Another stock we're avoiding is AGL, which has been in the news for some time now due to a potential demerger of the business, but also a potential buy target from Cannon Brooks and his company. Look, all in all, we do think there is some structural and operational issues with the company. They're not getting the support from the shareholders as well. And currently, look, until that's sorted, we will be avoiding that stock. The key to buying a stock is not just based on share price, and that this is something we want to reiterate to investors today. Sometimes you just look at the chart and go, well, this looks cheap, big company, well, surely it's going to bounce. Not always. You have to look at fundamentals. You must look at the balance sheets. You must look at what's going on with the management, and all that is called a fundamental analysis, and that's what we do at Fat Profits. Currently, this stock is an avoid. Next stock is Zip, and this is another one we're avoiding, and we've been avoiding it for over 12 months. Ed, you've had a number of people asking, can we buy Zip now? Surely it looks cheap. What are your thoughts there?
Yeah, look, it looks cheap, but the whole buy now, pay later sector has been smashed. You would have seen CBA in the news. They're potentially about to write off Klarna, which is their Swedish investment in the buy now, pay later sector. You know, at the time, people thought, wow, you know, they're investing in a European, you know, buy now, pay later, you know, leader. Unfortunately, they've lost their money in that investment at the moment. They're about to potentially write that off. So, look, for speculators, maybe a bit of a dead cat bounce at some point, but gee, there are much better stocks to invest in right now. So this is an avoid, and we've been avoiding it in our free webinar, believe it or not.
Yes,
for
absolutely.
I think almost 2 years, Roger, because we buy stocks generally for medium long term, which is anywhere between 2 and 5 years. And yes, yeah, you can get the algorithms and the speculators and the day traders pushing these stocks up for their own agendas. But if you're left hanging, you've lost 90% of your money on this stock. It's as simple as that.
A lot of people feeling the pain in these type of stocks. And look, this is important to know what to avoid. And we tell you that at Fat Profits. Last stock that we're going to tell you today to avoid is Magellan Financial Group. This is a stock we know very well. We bought it early in the days. As you can see in the top of the screen, we bought it in 2012, about 10 years ago, at $1.74, when they were a sort of a small to medium-sized business. Hamish, obviously, and the management team. We sold it at $25.82, huge gain of 1,600%. Look, its stock went up to $70. So did we miss some of the gains? Of course we did. But look, if you're sitting on 1,600%, you probably take it. Since then, look, there's been a lot of issues. They've had people, they're one of the biggest investors leave. They've had structural and operational changes. And a lot of people have been emailing and calling us and saying, should we buy at $20? Should we buy at $15? Surely it looks cheap. But until and unless there is a green light in fundamentals, you don't move forward. So we are avoiding this stock even at $12 today. So that's 4 for you. Now at Fat Profits, we also share with our paid members, 25,000 of them, as to when to sell the stocks. And this is a list of our recent sell recommendations that we've taken some profits off the table. And you can see a few names that you may hold or may have been looking at. Sonic Healthcare, for example, you may own that stock. Domain Group, maybe you might own that stock, and that was a pretty good timing. These are all 10K investment returns, and you can see some of them have produced some fantastic returns on a 10K investing. Domino's Pizza was another one, but Ed, we don't get all of them right. I mean, we've got a couple of them wrong. We've lost some money, but generally speaking, we're getting more right than wrong.
Yeah, it's all based on fundamentals. Now, we got out of those China A shares ETF and the Asia ETF, Platinum Asia, all at the right time. And then we had nothing but declines after that. So that was all timing. We took timely profits on Domain and Nine Entertainment. Vocus was obviously taken out. Omni Bridgeway got out of that at the right time as well, and Borrow with the
sale of their business,
part of the capital return to shareholders. So that was quite timely as well. So yeah, it is all about timing, but we do take profits. That's the message we're trying to portray here.
All right, excellent. Well, it's important to take profits. There's no doubt about that, especially in volatile markets. Next up, let's look at a recommendation for you in hard commodities. So we're going to look at lithium and nickel. As you can see on the charts, amongst hard commodities, lithium and nickel have been absolute standouts. And certainly that's something if you missed out on. Coal's another one. And we've got a couple of recommendations in energy and coal. If you missed out there, that's something to think about. But electric car batteries, they're also used for lithium and nickel, also used for mobile, many other sources, which is huge demand at the moment. In fact, talking about demand, let's have a look at the nickel price for a moment. And you can see the chart's obviously gone through the roof. And there's a good reason for it, because demand is outstripping supply. And you can see here on this chart, the demand for electric vehicles is clearly, actually electric car sales have doubled from 2020 to 2021. Did you know that? The car sales around the world have doubled. But wait, there's more, because there's more to come in 22, 23, and this is leading up to 25. This is the expectations in the global electric car market. So what's a stock that you can look at? If you haven't looked at it yet, one stock we can give you today is Independence Group, IGO. That's a company worth about $8 billion. So certainly a blue chip stock in the top 200 on the ASX. And this is their expectation on clean energy metals, lithium and nickel. This is what they're expecting over the next 8 years up until 2030. And recently, they've also bought another company called Western Areas, Ed, because Western Areas is a company that we also own in our portfolio. They've bought that. So their portfolio has now become larger, right?
Yep, so members that own that stock have just been paid out for that investment or about to be paid out. So yeah, this is a leader. So we're sticking on the big one. So just on your previous notes, Rog, we do have a special battery metals report that we released to members recently, and that was in response to Goldman Sachs report. And we argued the fundamentals versus their particular prediction. And their prediction actually moved those stocks on the day, and subsequently, some of these smaller speculative stocks have copped a pretty big hit. But we're in fundamentally sound businesses here. and that's why we're sharing it with you today. But yeah, we're still bullish on the sector, but not all stocks are going to do well going forward. It all comes down to controlling stocks, offtake agreements, and so forth, and guarantees of supply. That's what
Yeah,
we're focused
absolutely. Very good. So they own lithium projects around Australia, as you saw in the previous slide. They also own nickel projects as well. So they're actually quite a decent operation. And this is a look at some of their lithium businesses. So they're certainly in both, and they're exploring for more. All in all, this is how the share price looks like. We bought them early in the piece around $3.44. They've gone through ups and downs, but generally up more than down. But recently they've come off along with the market from $15 down to 10. So we do see some value here. And with the merger now complete with Western Areas, that will strengthen the balance sheet as well as their opportunities to capture more market share. So this is another stock that we're giving away today for you guys, absolutely free, not a problem. See if you can make some money and you can thank us later, not a problem. Another stock we're going to give you today is Bubs Australia. This is the infant formula maker in Australia. It recently been in the news because Joe Biden sent a tweet saying that they've struck a contract with Bubs Australia because there's a shortage of infant formulas in US, and they'll be supplying 27.5 million bottles to the US, which they've already started doing. That sent the stock price up 40% on that particular day. Now, the Bubs have also come out and said they will be expecting a forecast increase of $100 million in their gross revenue and achieve that compared to last year. So that's a pretty significant increase, of course, in their gross earnings. And now they've got a contract with 1,000 Walmart stores around the US. So their products are on their shelves, and they're getting a pretty good marketing center stage in the US market as well. This is the forecast for the next few years in terms of net sales by product, looking obviously way better than the last 3 years. So this is going to be a game changer for this company. The share price, how does that look? Currently, it's sitting around between 60 and 70 cents. You can see recently we bought it at 35 cents. Previously, we've had it for 40 odd cents. And on the day when the stock jumped, this went up to as close as 85 cents. Since then, there's been a consolidation, bit of profit taking, but it's held up pretty well. And now between 60 and 70 cents, we see some value. So this is another stock for you as a buy recommendation. Ed, any points from your side?
No, that's all. And they were first to market, so they already had agreements and FDA approvals as well. So all the other baby formula companies are all rushing out, trying to get some agreements. So these guys have got their foot in there, and at some point, they'll probably get their supplies back up. But what will happen is consumers will get used to this product and they'll keep buying it.
Yeah,
And that's why
absolutely.
we're on stock.
Great. And we've got a hidden gem coming up in just about 5 minutes. We've got an absolute golden opportunity to buy a cheap stock in terms of share price, but lots of potential growth. So stay tuned. We'll come to that in a second. Next up is we'll look at Fat Profits performance. And this is important because, of course, we can sit here and talk about stocks and whatever else, but if you're no good at it, nobody cares. But we are good at it. That's the beauty. We've been performing. This is at our annual returns since 2000. So 22 years of history. In the Australian market, we've been averaging just about 18%, so 17.8% per year for 22 years versus the market, which has done 8.5% per year. So we've been outperforming the market by more than 9% per year. And that is not easy to achieve. Let me be straight up. This is extremely hard for any investor to beat the market consistently for 22 years. Anyone can do it for 1 year or maybe 2 years, but to do it consistently for 22 years, well, we must be doing something right. Now, do we get it right all the time? No, we don't. Are we perfect? No, we're not. Do we have a crystal ball? No, surely we don't. These are our breakdowns for yearly returns. So 2020, we had a pretty good year versus the market. 20% versus 3% look pretty good. 2019, look, we put our hand to heart and we say, look, we could have done better, but we didn't. The markets did 24%, we did 19%. So the markets got the better of us. So we will take it, absolutely not a problem. But 2018 and 2015, we do our best work when the markets are down. Markets were down 3.5% each. We were up 10% in 2018 and in 2015 we were up 18%, which is absolutely huge. So all in all, generally speaking, look, we get it right more often than not, but do we get it right all the time? No, we don't. So are we medium to long-term investors? Yes. Do we want to trade, buy and sell? No. So if you're looking to trade, buy and sell every week or every month, well, our service might not work for you. I mean, you can still do it, but it might not be ideal. But if you're happy to be patient, you're happy to hold quality companies like Elders, like IGO, like Chalice Mining that we've shown you so far, then you can make a lot of money, because 17.8% a year is a lot of money if you can make it consistently from one year to the next. And this is how a lot of money looks like. If you invested $10,000 in 2000 and you added 5,000 per year to that over 20 years, you'd be sitting on $1.6 million today. That's the value of compounding. If you can maintain it consistently for a long period of time, then of course you can create wealth for your family, which is what we want. Ed, over to you. You know, 'cause we don't have to sell this ourselves. Our product sells itself, but we'll have lots of testimonials from paid members on our website.
Yeah, we've worked very hard, Roger, especially over the last three years, I'd say, to turn this business into the leader in the industry. We are considered one of the leaders, or if not the leader, in the self-guided industries, because we value our members. We provide support. You know, we've got real people here. You can call us, you can email us. My members email me all the time. Sometimes I don't hear from a member for 6 months or 12 months even, and they'll send me an email out of the blue, usually when the market's down, asking questions on certain stocks. But the value is you get support, you get everything that you need to be able to do it yourself, and you educate yourself over a long period of time. So a lot of these members, they say in their testimonials or their reviews that they put on product review, that they wouldn't have been able to get those results without our support and without our advice. So great to see those. You know, just makes it all worthwhile and makes us proud to work here, Rog, really.
Absolutely, agreed. And a lot of these are, look, some of them are retired fund managers, stockbrokers, and a lot of them been with us for 8, 10, 15, even 20 years. And these are all real people with real reviews. So you can check them out. We're going to give you a few reasons to join us today. Before we get to the hidden gem in a moment, the first reason for you to join our service today is, of course, our performance. Because without that, you know, nobody cares. 18% a year for 22 years. You must look at that. Secondly, we will save you time on your research so you can manage your portfolio better. Do we have management who can look at the market for you? Yes, we do. Do we get 10 out of 10 right? No, we don't, but we do get 7 out of 10 right. So we certainly have a good track record, and I'm sure you'd agree. If you can get 7 out of 10 right, you'll be pretty happy with that. The other benefit of joining our service is we don't do any marketing to our paid members. No upselling, no direct marketing, no emails about buy this product and try another product and try another product, which is annoying, let me be honest. Some of our competitors do that. And we also manage real money up to $1 billion. So these are a few reasons for you to consider our service, but I'm going to cut straight to the chase, and I'm going to tell you about our 3 levels of membership. We have a standard, premium, and platinum. These are the 3 levels. Standard is an entry level. Premium is what most people want. 70% of our members have premium, and platinum is about 25% of our members have platinum. What's the difference? Well, either one, which whatever you join, it's the end of financial year now, only a few days to go. We've got a tax, this is a tax deduction for most people, but you can speak to your accountant about that. We'll give you a tax invoice, which can be made out to your self-managed super fund or your own personal name, whatever you prefer, not a problem. Now, how does this work? Let's say you take the standard membership. You get daily fat chat market commentary, so daily email from Angus every morning, which will highlight what's happening in the market. Absolute gold. Our members love this every day. You get a weekly members only webinar. Every Thursday, we do a live webinar at 12 p.m. for 1 hour. If you can make it live, you would be informed about what's happening in the market this week, and we cover 15 to 20 stocks in that webinar: buy, hold, sell, and avoid. So you'll get lots out of this. If you can't make it live, don't worry, you can replay the recording later on, not a problem. We email you the recording. Third, is you get a Friday Fat Wrap, which is a wrap up of the highlights of the week on a Friday evening. So if you've been busy during the week, not a problem. You can catch up on a Friday and we will let you know what's happening in the market. So those three benefits are common across the board, standard, premium, platinum. All three members will get that. Standard member can choose one out of the 4 reports that we publish. The 4 reports are Australian equities, which covers Australian market. Second report is global mining, which is mainly for mining sector only. And it covers mostly Australian miners, but also has some international miners. Third report is global equities, which covers global markets, including US, Europe, and Asia. So if you're an international investor, you must look at that. And final is UK equities, which covers UK market. So you can choose any one out of the 4 reports and you can become a standard member. The benefit of premium is you will get 2 out of the 4 reports, and usually the combination for Australian investors is Australian equities and mining, because that's the 2 which people want. As well as you get an account manager. So this is handy because you can email or call them if you have questions about market or stocks, and they can help you, give you some direction. Final is platinum. This is our, of course, our top level, where you will get all the bells and whistles, where you get all the 4 reports, local and international. You get a premium account manager, and of course, you get the absolute top level of service. So if you're interested in that, you can let us know. Now, what I want to show you just very quickly is our members website. And it's very simple, and this is how it looks. Once you remember, you get your login, you sign in, and you scroll down, and these are our 4 products. So you've got Australian equities, UK, global, and the mining. Now, depending on your level, you click it and you will see all these information tabs. So you get a latest weekly report in Australian equities, for example. It gives you 4 to 6 recommendations per week on buy, hold, and sell. You also can see a list of all of those recommendations when you click new recommendations in a table format. You can see our Fat Profits portfolio, see how that looks like, and you can marry that up with your own and see if we're saying buy to those that you're holding or selling to those you're holding, and then you can make up your mind. Then we have all our past winners and losers right here, 7 out of 10 winners. So you can see all of them here. Midweek investor alerts. So if there is something happening to a stock, good or bad, we will send you an alert to your email midday. Then you have that income portfolio that we shared at the beginning of the webinar with 22 dividend stocks performing at 17.1% a year for 10 years. That's where you're going to find it, updated on a quarterly basis. And finally, all our webinar recordings are here. So if you want to watch a recorded webinar, which we do weekly, all the recordings are placed there. So you can choose 2 reports. If you want premium service, you can choose the mining and Australian equities, or if you want all 4, then you can choose the platinum service. Now let's get to the chase and let's talk about the prices. Again, the prices are all on our website too. You go to products and you can see all our prices. A standard membership goes for $1,095 a year, and 2 years is slightly cheaper. Premium, best value for your money, $1,545 for a year, and 2 years slightly cheaper. And platinum is $2,590 for a year, and again, 2 years is a bit cheaper. You can purchase these online, not a problem. Just pay the normal price, and a lot of people do. That's fine, no worries at all. However, we do have an opportunity today where we're offering some special prices. So Ed, I'm going to pass it on to you so you can tell us about these end of financial year deals that we've got available.
Sure. And just quickly, Roger, we're not stockbrokers, so there's no buying and selling through us, and we're independent to brokers. So yeah, all our members have their own platforms, whether it's CommSec or ANZ or Westpac. You do your own buying and selling. We provide the research and advice and the guidance, and you as a self-guided investor can benefit from that, make as much money out of this as you like. So there's no commissions to be paid or anything. So it's purely a subscription fee, standard. If you've been on these webinars before, you would know that we've never put these prices before. Okay, they're usually much higher than this. So it's a one-off. It's basically to get you on board today, and especially while the market is down. We believe you'll probably make some money as the market recovers on the stocks that we cover and that we're going to recommend to you once you've joined. So $695 for a standard membership. That could be equities, mining, or even global or UK. We explained that already. But the best value is when you get the account management service, which is what me and Roger do and the rest of the team. So you'll have someone here to talk to. When you need to, you'll be able to email them questions or call in if you really need to and ask some questions. So that's $9.95 a year that Roger just showed you. It's $15.45 retail, $9.95. That's our lowest price, Roger. I can't remember the last price, probably in a couple of years, probably back to the start of COVID. So probably in 2 years, but it's only a one-off. It's only for now and for people that have watched this webinar only, or 2 years for $15.45. So basically 2 years for the price of one, reduces your annualized cost to just $7.79 per year. Look, if you've got a self-managed super fund or you're going to be in the market long term, usually our members renew for 3, 4, or 5 years. But for new members, we want to try and reduce it if we can. I know we've given away 4-year packages in the past, but at much higher prices it is. But look, the best value, honestly, for end of financial year is $1,995 for 3 years, and that equates to just $665 a year. And I haven't seen that price since I joined in 2011. We used to have that price on the website as the best value plan, and that was what, 11 years ago. So that is an absolute one-off, and that is a fraction compared to what most people pay. So this is a genuine incentive to win your business. I know there's people on this webinar that have probably been watching this for years, some of them for up to 10 years and have never done anything. This is a genuine opportunity for you to join today. If you've been on the database forever, here's your chance. The market is down. There's more chance that you're going to make money from here than not. The market's already corrected. So you got more to gain than to lose by joining on that offer today. And then for platinum members, larger portfolios, more savvy members, especially members that usually invest in funds and ETFs, they've copped a bit of a whack recently. So we can show you some individual stocks in those markets rather than buying the entire fund or ETF. You can buy those international stocks, in particular in the US or Asia, for instance. You've only got to download the foreign exchange form on your ComSec account. It's very simple. And then you'll be buying those stocks in Australian dollars. So $2,995 for 2 years, $15.90 for a year if you want to try it out. But the best value, this is even cheaper than what we're offering for premium for the last year or so. $2,995 for 3 years, and we'll offer you an annual portfolio review, not just a one-off, an annual portfolio review. So once a year, send in your portfolio to your account manager. And we'll get that reviewed. We'll go through each stock with you in a fine ruler, and we'll give you our view on that particular stock fundamentally and technically. Now, the members that want to join for 3 years on premium, Roger, I reckon we haven't done this for a long time, but I reckon the first 20 that click on the 3-year offer will get a one-off portfolio review. So we'll put that on your tax invoice. And a lot of our members have been calling in and asking for reviews. They've got to renew before they get the review, and we'll do it as a one-off for them. Or upgrade their membership for longer, some more longer time.
We've just got a question, Ed, from Karen. Sorry, I'll just take this question quickly. Karen, in fact, the ladies seem to be asking a lot of questions. Karen's saying, I'm an international investor, and obviously my portfolio is a bit down because of the market. She's interested in the platinum. She's just saying, if I took the 3 years platinum versus the premium, so the platinum will give me an annual portfolio. She just wants to clarify that platinum will give her one portfolio review per year, but premium, you're saying that for the first 20, because the premium currently, just to be honest, portfolio review does take time. We've got to give it to our team of analysts. They've got to study, come back with some recommendations, and then we do a half-an-hour appointment over the phone to go through all the strengths and weaknesses. So it does take time, and we're busy at the moment, and because of end of financial year. So Karen, to answer your question, the platinum, not a problem. That one for 3 years, if you take it, we'll do an annual portfolio review, and we can do one every year, not a problem. With the premium though, Ed, what you're saying is, look, first 20, if they do the 3 years, I think that would be enough, because that'll get us through till the end of the month, and that's fine. We're happy to open that up, but after that, it's just first come, first serve. But it certainly reduces your price anyway, even if you don't get the portfolio review. That price of 3 years, $665 a year, that's not much. I mean, you can make that in an hour of trading in the stock market.
What we offered on our last webinar for 2 years, so you're getting basically a year for free. plus a
All right.
portfolio review. Yep.
Excellent. So let's put up a quick question here where you can express your interest. So the question is on your screen. So if you are interested in standard, premium, or platinum, you can make your selection now, and we will contact you to discuss. Of course, we're looking for serious investors who are genuinely interested in, making a change, because really, if you keep doing the same thing over and over again, you are going to get the same result. Let's just be straight up. But if you're open and willing to make a change at our lowest price, this is a huge incentive for you. It's the lowest price we've offered for a couple of years, and we're doing this as a one-off today. So if you're interested genuinely today, let us know, make your selection. We will get in touch and we will help you navigate you through the markets. We'll hold your hand, give you some advice, and it's all up to you. You manage your own money. We don't touch it. You control it. There is no marketing. It's very, very simple. So while the people are making this selection, I can see here, Ed, there's about 60% have clicked on premium so far, and there's been about 15, maybe 16% now. It's changing every second, but going with platinum as well. There's been a couple with standard, but not as much, and that makes sense because better value, certainly premium and platinum. Look,
Yeah.
one last, before we get into the hidden gem, I'll take one last question. This has come from David. So we've got the men asking questions now. David's talking about account manager. So maybe just very briefly, he's asking, he used to be an ex-member before, he's saying, and he's saying, thank you guys for the presentation today. It's been quite informative, and I'll check out some of these recommendations. His question is, the account manager, what kind of advice and how often they can speak to the account manager?
Look, it's generally just to clarify any questions you may have. So it could be a research on particular stock in the reports, and we'll clarify that on the day. So you could email it or call it through. No personal advice. So you can't say, oh, Ed, there's 3 stocks here. Which one do you think is the best one to buy today? Unfortunately, I can't give you that, but we can guide you in the right direction. So look, clarify anything that's in the reports, have a quick general discussion. If you're a bit annoyed about a couple of stocks in the portfolio, give us a call, we'll have a chat. It's having that support without going through a stockbroker. And at the end of our conversation, you're not paying any brokerage fees. It's all part of your membership. Okay?
Yep. All right, excellent. All right, we'll close that now. And finally, let's just before we wrap it up, we're going to go through the hidden gem now. So this is a stock we've just introduced to the portfolio about a month ago. And Ed, maybe just in 60 seconds or less, if you can tell us briefly about this dairy farmer / milk and cheese and global food company. They're certainly in their, going through the phases. They've got a 10-year business plan to go through, the capitalizing the market share. These are how the numbers look like for the different products. So what do we like about them?
Well, firstly, they've told us that they'll report a statutory profit next reporting season. They've already declared that to the market. So they're moving from infrastructure costs and building plants and ramping up production and doing deals with offtake buyers overseas for their products, which are very valuable in protein, lacto products, to support the immune system, dairy, food, meat, nutrition products globally. They've also got technology and food traceability and anti-counterfeit technology. So it's a rising company, it's a growing company, it's in the right environment, it's in a food inflation environment. Fundamentals are strong, technicals are, well, it shut the lights out when we first recommended it, Roger, and then we had that little mini crash in the market. So the share price has come back now to very close to our initial buy. So anyone that's missed out, our members in particular that missed out previously, have an opportunity to buy the stock. It is thinly traded, so it's not a day trader stock. It's one to buy and hold. And it's one that we believe would be, what is it now, around 6.5, 6.
Yeah, 6.8.
It's in the 6 cent range, so it's a micro cap, but potentially could be a 20-30 cent stock in your portfolio. So we would only put this stock in this webinar as a hidden gem, as we have in the past. Most of the past stocks have been mining stocks, and they've all gone up and stayed up. So they've all made members money. We would put normally our most attractive opportunity in the webinar, basically, because we want you to make money initially and get you off to the right start. This stock may not be for everyone. If you're an ASX top 200 investor, for instance, you may not look at this stock. But if you've got a smaller portfolio, or you're looking to add, a few $1,000s on a small company, this could suit you. If you're a dividend investor, for instance, it may not. So it is speculative, but they've ticked all the boxes. They're infrastructure ready. They've spent all the money on the infrastructure, so they're not going to be affected by inflationary pressures. Anyone that's got to build infrastructure in this environment is going to struggle, and they're going to be paying a lot of money in repayments for their loans. So these guys are well set up, and we believe it's an absolute opportunity, and that's why we presented it to our members recently, as a micro cap opportunity.
Okay, excellent. So we just bought it at 6.6 cents. It went up to about 9.5 cents, so up around 50% in a month. Recently, it's pulled back to between 6 and 7 cents. Currently, we see this as an opportunity. Even if you want to chuck in 5 or 10 grand into a small speculative stock, this could easily recoup your investment with fat profits very quickly. So this is one for all members joining us today. So do ask the question when you speak to us, and we'll be happy to provide that to you once you're a member. So look, that brings us to the end of today's session. Thank you for your questions. Thank you for your company. If you've made up your mind that you are going to finally join Fat Profits and you're willing to give us a shot so we can help you make some changes and get better returns for you, well, congratulations, because an open mind and an open parachute works, and a closed mind and a closed parachute doesn't. So if you open up your mind and your wallets, and we will give you a tax invoice for your purchase, congratulations, and we look forward to working together. For the others, if you're still thinking about it, well, have a think, not a problem. But you've been thinking about probably doing something for a while. Maybe if you watched this webinar in the past, as Ed said before, well, what else can we do to make it easier for you to join? Have a chat with us, not a problem. We will help you as much as we can. However, you need to come to the party for us to help you. And these are the lowest prices we've offered you for the last 2 or 3 years. So this is a huge incentive, only available for a short window before 30th of June, and then it all goes back to previous prices. So on that note, I'm Roger. Thanks for your time today. I'll pass it on to Ed for his final words, and we'll wrap up.
Absolutely, Roger. There's the 1300 number there at the bottom of the screen. So if you'd like to speak to myself or Roger personally, just call in, leave your details, and we'll give you a call. Otherwise, thank you very much for joining today. We've shared a lot of valuable information with you. All the best in how you use it, and looking forward to welcoming new members on board.
All right. Thank you.